We will see the highest failure rate at a company level of the history of tech.
Second-time author with a book about to come out, The Science of Scaling. Famous lecturer, CRO, investor, Mark Roberge. You are the CRO whisperer.
I have so much conviction that if we look at the index fund of the last 2 years of AI native investments that were done, we will see the highest failure rate at a company level of the history of tech. Founders are still messing this up. It's like, oh, we chose the timing on when we would scale revenue based on when we got money from a VC. Did you assess whether you are ready? No.
Hey everybody, welcome to Top Line. It's Sam Jacobs, the CEO of Pavilion. I'm joined by Asid Zaman, the CEO of Sales Talent Agency, AJ Bruno, the CEO of QuotaPath, and good friend of the pod and second-time author with a book about to come out, The Science of Scaling. Famous lecturer, CRO, investor, Mark Roberge. You are the CRO whisperer, thanks to your work, your seminal efforts with the sales acceleration formula, which everybody in the world read. And we're so excited about your new book, The Science of Scaling, which I think came out last week officially. January 20th was the official release date. But you said you don't have a copy yet?
Yeah, I think that Amazon said February 2nd or 3rd, but somehow these copies are getting out there. I keep getting pictures of people reading the book. I don't have it yet.
I'm on Amazon
yeah, they're
right
trickling
now.
out.
January 20th.
Really? That's what? Okay, cool. So they're coming out.
The hardcover.
Mine's stuck in a snowbank somewhere. Then I don't know.
My important question here is, Mark, is there an audio version of it on February 2nd? Okay,
yes.
is it
I got
read by
denied
you?
from being the reader.
You're not the reader?
I got denied.
How did you get denied from your own book?
They were like, okay, we outsourced this to some firm. They don't like the authors to do it. They've tested it, and these professional people perform better. But if you want, why don't you do a 5-minute reading and send it to us? I'm like, all right, cool. So I sat there. I probably should have taken a couple cuts at it, but it was like, all right, whatever. I'll read. And they send you them. They're like, well, denied.
That happens.
It's not coming out till May, I guess. So yeah,
oh, really?
It'll take some time.
Oh man, I almost all exclusively.
Here's what my
read
partner does
books.
though. When she reads a book, she buys both the book and the audiobook because she can go on the beach and listen.
That's what I do.
And then she can go at night and read and pick up. So like, hey, do them both.
That will be mine.
Do you get to approve the final person's voice though? So they rejected you.
I doubt it.
No?
I would think it was years before I even listened to the Sales Acceleration Formula 1. Like people would come up to me and be like, oh, I thought you had like a British accent because I listened to your book.
You become very attached to the person that narrates it. I can attest to that.
Probably.
That's
I mean, I wish it was like, I loved Matthew McConaughey's audiobook.
Did he read Green Lights?
I listened to it. It was one of the first books I finished, and I was like, I wish there was another chapter.
Can we get the 5-minute recording of you that you sent to your publisher?
Yes.
I just want that.
You're like, dude, you really should have like made an effort here.
Let's jump into this. There's a lot to discuss.
Mm-hmm. There's a lot to discuss, everybody. We're talking about all things AI. We're talking about strengths and weaknesses of go-to-market from the SaaS area. I think we should be talking about Mark's book, The Science of Scaling. We're going to be talking about revenue-generating activities, everybody's favorite current acronym, and where do we see AI and go-to-market heading by the end of 2026? So, sorry to cut you off, Asid, but I'm going to hand it back to you, sir.
The frame, Sam. I appreciate the frame. Mark, let's start with a little bit of your investor hat perspective on the market. So I think culturally something interesting that's happening is all of this turnover at these AI companies at the AI researcher level and then the founder level. Thinking Machines is a recent example, but this has been happening pretty across the board at these leading AI companies. And I'm curious how you're computing that from its impact on our overall culture perspective. Like when you guys are now deploying capital, I'm sure back in the day, there was this expectation that founders are going to stick it out together for a certain amount of time. Like there's going to be some stickiness at the founder team level. But now within a 12-month period, if people are leaving, does that have a downstream where other founders start doing that? And then do you guys worry that this is going to have an impact on other functions, like go-to-market people will move around more, and there'll just be less loyalty and stickiness with any given organization. As an investor, do you worry about this?
It hasn't come up often Asad, to be honest. I saw your questions and it provoked some thoughts. I'm like, am I missing something here? What's going on? Am I like, is it gonna start happening? There was a part of me that was thinking, okay, and I can make an argument. It's super isolated in these, foundational models and labs and this particular type of 20-year PhD, super valuable, intelligent person that's valued right now for this moment in time. And I think that's where a lot of it we're seeing with the windsurf story and more recently the Thinking Machine story. And it's going up and down. Like, I think the second half of last year, I think Zuckerberg, someone told him why are you spending all this money on the models when you should get the talent? And he started dropping hundreds of millions of bonuses. Mm-hmm. And then he stopped, I think in November and put, you know what I mean? So so I personally think my first instinct is it's a fairly isolated situation at that extreme level within that very microcosm of type of business and type of personnel. That may go away with time, and it doesn't significantly overlap with where we invest, which we don't do foundational models. These are more SpaceX type investments with lots of capital. We like to be a smaller fund of 100 mil. We just think the VC math works there, and because of that, we can't invest in companies that will require 50 to 100 million of capital before you sell a customer. It's just not our play, and that's fine. Now, I think the only signs I'm seeing a little aside, and you've tried to broaden it out to go to market and where we headed. We've had a couple founders, maybe 2 or 3 out of 100 folks across all of our fund entities, where they were I've been at this for 7 years. I think we missed the window, and I would just be better off starting an AI native company. And from their standpoint, yeah. And that's just a tough situation because in some cases they've got some tailwinds around their pivot, and that's just a tough situation. And we're seeing just a little of that. And I'm trying to think. I think we did have one where
what do you think of that? Because one can kind of empathize with both sides of it. If you are an investor, you want the person to just want to continue with the idea, keep looking for the unlock, be resilient when there is any sort of friction or challenges. But on the other side, you talk to some founders, and this is just broadly speaking across lots of founders who have broad range of investors. Sometimes when you're stuck as a business, the board can also hold you back from getting unstuck, right? You have to spend money on R&D. You have to do these things to try to find the unlock. And then the board dynamics aren't enabling it. There's cut the cost, do this, do that. There's a lot of control that other people have. So founders feel stifled, and they're like, what if I just leave this thing and I start something new and there's no baggage and I'm not dealing with these investors. And so we hear it a lot actually. And so how does that, which side of it do you play out on? Do you think at this point in time, the opportunity is so interesting and so big with AI that if you are a founder stuck for 7 years and you decide to go do something new, so be it, it's fair?
From their standpoint, yeah, I think there's all sorts of circumstances in there. I think there's a lot of great founders that I know that are stuck in walking zombies, which are way too overcapitalized, missed the window, and they should be doing something else. And that's fine. In a lot of cases, VCs kind of write those off as well. We have a couple situations where they successfully pivoted and are now accelerating, but they're just tired. And that's fine. If you want to go do something else, cool. But there is obviously the side effect of there's a reputation and it's a small ecosystem, and you if you're going to, have righted the ship and you don't want to necessarily see it through, as the operator, have a plan. Okay, cool. I'm going to carve out this much equity and obviously my salary goes away. And here's how we can work on a transition to continue to drive this tailwind.
Here's my 2-week notice. I'm out.
Yeah. As opposed to I think we should just shut down. It's so yeah, people do get tired. And as an individual level, you have financial responsibilities and passions, and it's a free country and in a lot of places that people are. And you should be able to go on, but also whether you're leaving an employer as an executive or individual contributor, or whether you're leaving a company as a founder, you just got to make sure what you're leaving behind is taken care of.
It's important, Asta, to recognize, just from a stage two, both as an LP and a portfolio company, where stage two sits in this. And I think the question you asked around board dynamics and board alignment, what I'm sure Mark would say, but I'll let him speak to it. But what I've found is that stage two has done a really, really good job of, as companies grow and take on more and more capital in the 2021 and took on a lot of stage two companies.
Yeah.
Probably were, including us, in that overinvestment.
Yeah, you're extreme
period.
version of that.
Yeah. Well, I don't need to get called out. I called myself
No,
out.
I talk about you in a good way of that. Like, unlike most, you did some of the most biggest raise.
Yes.
But also, like, your burn's been.
We've
hasn't been super tight, but it's been a lot tighter than most. You didn't burn through it in 18 months.
The last 3 years, we made sure we were heard from the board on burn. But the reality is that's true. Is like you have this situation where you have an early stage investor who wants to, like, they invested and they backed the founders. And Cassie Young, actually, talking to her, said one of the things that she found most unique about venture is just that you invest in these founders and you want all of them to do great things and win. And the reality is that's just not what's possible. And so it's this emotional tie as an early stage investor to want the founders to do great things, but at the same time, you just have to know when to call it and write it off.
Totally.
And that sounds like it's a really, really big challenge, which I'm sure it is. But at the same time, you don't have say in the business.
How many stories of companies, and this is where it gets complicated, right? Is that there are many stories of many organizations that took a really long time to get to escape velocity. Some got stuck and then got unstuck. Like, it takes time.
I think Replit's like one of the most famous stories about that, if I understood it correctly, because I was at the HubSpot's AI conference in San Francisco in June, and I was on a panel with him, and we had a coffee before. From what I recall, he started the business something like 2014, and it was almost like an open source library. It didn't get any traction, so he just let it sit there. Went and did something completely different for 3 years, and then it took off, and now they're worth billions of dollars. You know what I mean? Like, if I understood it correctly, and Figma went through like 5 iterations like
we
that.
had the guy from Bolt on, and he was working on it for 7 years.
Yeah.
Before, I think they might not have even had any revenue at all.
I mean, he called it out in the podcast, and he just said his investor, and I think he was open in the conversation around Insight. Just was like, yeah, at the end of the day, in August or whatever, they were calling for capital to come back, and then we took off and went to 10 million in 2 months.
And then went to 40 million in 4 months. They went it took 7 years to get to 700,000. It took 4 months to get to 40 million.
AJ, when you hear about Mark describing, because the thing that's surprising to me is the company is accelerating, but the guys or the gal, the person is going to go do something new. So, sometimes I hear people are tired, and I'm thinking that maybe they just need like a vacation, like go to the beach. But I normally associate burnout or fatigue with working really hard without seeing results. So like to finally see results for the project that you've been working on so long, and then that's when you decide that you're tired, feels strange to me. What do you think? Because I know you've gone through periods of fatigue with QuotaPath, and now you're accelerating again. And I sense from you an energy. So I'm just surprised at that comment.
I don't know. I think that there's both sides. There's a burnout factor when you don't see the results, but then there's also a burnout factor when you're seeing results on one side of it, but that there's still 4 different broken things in the organization. And like the example I'll give, I have kickoff next week in San Diego. There's so many amazing things. And Mark and I have been in touch about this opportunity that we have. And we're launching an AI native product, and we're getting such great signals from it. It's so cool to see it. But on the other side, you have like some of our biggest customers that might be struggling with an integration, and I have to jump in and actually be the person.
Business, AJ.
It's business, but my point is that's what the tiring things can get tiring out, because you're compartmentalizing. You guys know this as CEOs. You're contextually switching every hour, and you have a family, and you have parents that are getting older. You have all these things. That's burnout.
If somebody did the analysis on all founders who decided to just walk away, I would say the great majority of them were in a company that wasn't winning, holistically wasn't winning. Like, I think it is rare that you're up and to the right and the person says, I'm out. Like the person might feel tired. The person might need to go take a vacation, do all of that stuff. It happens, and we get tired too. But I think walkaways at that point are very, very rare. It could be like a health issue that came up. I think it was like the GitHub or GitLab CEO who had to step away when the business was doing okay, but he had like a health issue and he had to go take care of that. That happens. I think it's very rare when a company is winning that a person just walks away.
You have some weird context right now, Assad, on that. Like, because the one that's glaring for me right now is they're probably gonna between 2 or 3x this year at like not huge numbers, but like 7 digits, let's call it, right? But not 8 digits and not 6 digits, right? So 2, 3x, whatever. It's not gonna like attract this really fancy AI Series A or B. And it's also not an AI native company. It's in a fairly sleepy but protected category that could get to like hundreds of millions of dollars. But again, it's not. So that's what's happening is, okay, they've worked, they've pivoted, they found this new vein. It's working. They're going to double or triple this year, very protected. And this could easily be a probably private equity exit between 2 and 500 million in the next 4 or 5 years. But like, they don't want to do it. And I can see that because it's like they're looking around and like, I don't think we've ever been at high of a FOMO period in tech right now.
Yeah.
Of the gold rush. And that's what he's feeling, you know?
For every company that they're FOMOing about, there's 30 companies that they know nothing, that don't know anything about. Like 7 getting to $1 million in ARR. And I appreciate that we've all got much bigger businesses than that, but it's still freaking hard.
So hard. I don't know about I'm struggling with this. Like, here's how I'm breaking this down right now. Cause like, it is such bubbly activity as you guys talk about and know, but like I have so much conviction that if we look at the index fund of the last 2 years of AI native investments that were done, that we will see the highest failure rate at a company level of the history of tech. Okay. Now, will the cohort perform it as an investment if you had an index fund? That I'm not sure of. I have some conviction that it won't be a great cohort, but it doesn't take a lot of $10 trillion exits to make up for everything else. So that's the only like caveat I have is, yes, I do think there's going to be a massive failure rate in the last 2 years of AI native investments that were done. But I do think that the cohort itself has potential because if there's 3 $10 trillion exits out of that cohort of whatever, 8,000, 10,000 investments, then that could make it.
You're not banging the table saying that power law is going to win. There's going to be 3 $10 trillion exits. You're saying I'm not ready to bet yet, which is still
I just don't have as high of a conviction that I have a super high conviction that the failure rate at company level will be high. And I have some conviction that the index won't be great because you're at the high type of this curve. But that's the only thing that could offset it is like these massive exits, which could happen.
One thing I think is some of these companies that are going to fail, it's because they're not going to scale scientifically. And that's where I think the best companies are going to employ what you might call a science.
Predictive traits, maybe? Predictive traits?
What was the cut I gave you on the book, Sam? Jeez, that was like huge.
Oh, we have to help you sell some copies.
It's all good. It's all good.
Let's talk about that because I think that is probably go-to-market is going to be, that's what we talk about on this pod. And I think there's still a lot of confusion about go-to-market right now. And I don't think anybody's got it all figured out. And we know that some people, I saw a blog post, so-and-so fired they hired an AI VP of marketing. And then you click through the article and it turns out I'm sending more emails to my database. That's the VP of marketing, AI agent, whatever. But when you tell us like what led to writing the book and how you think it applies, because I feel like it really does apply right now.
Yeah, thank you, Sam. That's going to lead you a lot with the AI stuff. That's going to be so fun to unpack with you guys. But as I was mentioning to you guys separately, is like I never set out to write a book. If some of you may know the sales acceleration formula, I never sat down and was like, I should write a book. That was like a breakfast in 2011 maybe with Jill Conrath, that if you've been around sales for a little while, you might have grown up with her books in the 90s and early 2000s. She has a new one out now. But she was the killer author back then and still has done great work. And she was like, let's write a book together. And that's what led to the first one. And I donated the proceeds to this great org called build.org. I had no idea it would become what it became, but little did we know. And all 4 of us contributed to this body of work over the last 2 decades that became like a data-driven blueprint on how to rethink go-to-market. That was awesome. And then same with this one. It was like, I do a lot of podcasts, webinars, keynotes, etc. This one derived from 8 years of post HubSpot living, angel investing, VC investing, board work, being like, why are some of these companies failing and some are succeeding? And it was like, it comes back to when they're choosing to scale revenue and how fast. And you go into a boardroom or a founder and ask them how they answer that, and it's like, not good. It's like, oh, we chose the timing on when we would scale revenue based on when we got money from a VC. Did you assess whether you were ready? No. We had money. And then like how fast? Like, I don't know. We did an Excel model and someone said we had a triple, double. And then we figured out our rep quotas and we ran a quick little calculation to see how many reps we needed. And we hired them next week. Holy cow. Like great businesses are failing unnecessarily. And so like Lemkin, fortunately, every other year has me do a keynote or so at SaaStr. So in 2018 or 2019, AJ has the raw notes when he was in the audience. I did this speech on the science of scaling like 7 years ago. And again, I do all these different speeches. And that
February
one,
17th, 2019, when SaaStr.
You want to pan up your notes? Let's see it, AJ.
Yeah, you see it. My beautiful handwriting right there.
I had no idea he was going to pull this out. Like,
oh yeah. This book
God,
is
I don't know how he
15 years
categorizes
old,
this
by
stuff.
the way.
That's insane.
It's my Bible.
So anyway, that, work, it went viral and everyone was like, hey, can you talk about this more? Can you blog about this? I think it was like the number one watched like SaaStr recording for a long time. And then then Jay Poe was like, hey, we should start a VC firm partially around this methodology. And then I wrote a 45-page ebook about it like 4 years ago. And then it just kept growing and growing. And then Stanford University was like, hey, could you publish this? And so then you're just called, right? Like sometimes, and that was one of like 10 keynotes I've given at SaaStr, never mind all the other. So sometimes you stumble across a work that becomes somewhat timeless and has applicability, whether you're selling software in Silicon Valley or tractors in Brazil or pharmaceuticals in Japan.
What I'm getting from this, by the way, is that you just need to take Mark to coffee and say, hey, we're going to do this together. And he's like, okay, sure.
Yes, with you guys for sure. Like, I mean, there's an endless opportunity. So that's what led to the book, Sam. And I think like number one, the first point was like, okay, founders are still messing this up around the pacing and we can unpack some of the principles. But I also think there's always a surprise Easter, egg around what could be for the future. And what I was forced to do over the years in developing the methodology and categorizing the book was to rip go-to-market down to its first principles. And because of that, I think it'll be quite useful to our current model developers as we rethink go-to-market going forward, to get ourselves down to first principles and write these models effectively.
Mark, I assume you wrote this book in your entirety, but I have the question that everyone's thinking. Did you use any AI with it?
Of course. And I didn't here's what I did. So like everything, I didn't go in and write a book by Mark Roberge on this topic and make it 250 pages and print it. Like it was a lot of time and effort and I'm proud of the sweat behind it. But of course, when I wrote, my first response to Jill Conrath when she was like, can you write this book back in 2011 was like, Jill, I didn't even break 500 on my verbal SATs. Right. And then when she was like, okay, this needs to be your own book, I had to find a guy that I actually exchanged sales coaching with that went to Penn that was just a great grammatical copy editor. And he made the book. There was all the ideas were mine, just made it flow better. And of course I use Grammarly for that in this one.
Does Harvard and MIT know that, by the way, that stat on your SATs?
Do they know that? Like you just put that English is your second language. No one checks. I'm just kidding. I didn't do that. But hey, MIT doesn't I was fortunate to get into MIT undergrad. I don't know why I didn't go. But they're one of the few schools that it doesn't weigh. I got a 790 on the math, right? So that's what offset it. And that's what they cared about.
You mentioned that you're stripping GTM down to its studs to figure out what are the basic first principles.
Yeah.
We're living in this world, as we said, right? You just mentioned at the top of the show, we're going to see such a high failure rate from companies that they might not have any principles. They're not operating from a first principle perspective. Their first principles are probably build a great product and they will come. When you think about some of the most misunderstood, beliefs in go-to-market right now that need to be corrected? What comes to mind for you?
Such a long list. We'll hit two. We talked about one, which was like formation of ideal customer profile. Whether we're in this Star Trekky world of like agents selling to agents, you still are going to need some form of ideal customer profile. Like, who did we build this for? Who was our best customer? And when I ask people how they calculate their ideal customer profile, the answers range from where we had the most inbound demand to where we have the lowest CAC. Like, who's the easiest to sell? I think both are brutally wrong. And I've kind of, you can almost calculate this. It should be correlated to where you have the highest LTV. Because like we've both lived in businesses where I've never seen a business that has some form of inbound demand and greater than 50% of their inbound leads should be sold to. It's just like, that's
a mic drop. That's great.
Yeah. I mean, even HubSpot, who is the master of inbound and had a very broad market. Like, who didn't we sell to? 30% of our inbound leads were ICP.
Oh, wow.
We threw away 70%.
You, in the sales acceleration formula, this is something I will always remember before I knew you, but I read the book, was that you said inbound leads have pain and you have to see if they're a fit, whereas outbound,
Exactly.
you know they're a fit. You have to see if they have pain.
The switch.
And I think you're so right that you get an inbound and you're just like, well, this is money. I got to, this is, how could I turn away money?
They wanted
and
a
the
demo.
answer is, if it doesn't retain, it's no good to you.
Exactly. So there's some people are doing it on the demand gen side. Some people are doing it at the closing side, represented by CAC or close rate or sales cycle, whatever. Both are wrong. It has to be lifetime value. It has to be like, what type of customer is succeeding with you such that they want to retain and buy more? And then let's extract back from there. And now, of course, we have to acquire those customers profitably. But like, we have to start with that as a definition of ICP.
Okay, let me play the other side of
Yes,
this. Let me try to push on this.
Yeah.
I think you're completely right on it shouldn't be CAC, it shouldn't be win rates, it shouldn't be those things. But when you talk about LTV, I wonder if one of the lessons from the SaaS era that we should take into the AI era is that we don't really understand how to calculate LTV. Because if you think about it, once you're a Salesforce, you might have all of this information that helps you precisely figure out LTV, right?
Yes.
But for a startup, you're just like hoping and praying and pointing into the future. You haven't had enough years at this, number one. Number two, in LTV goes this assumption from the SaaS era that we can hold on to these customers for a long period of time.
Right.
If we can give them value, we can have this relationship into perpetuity. It's why we're willing to lose money to gain market share that we can then turn into profit one day in the future. But if you look at like how many SaaS startups eventually were able to get to that transition point where they were able to actually generate profit, very few did.
Yes.
And along the way, many lost all their customers to other people. Last point on that, I did an analysis at SDA a little while ago. We've been at this for about 20 years. And I couldn't find any software other than LinkedIn Recruiter that we had for 5 years or more. And I'm sure in their calculations, there was a lot more LTV associated with, customers, but we've never had one that stayed more than 5 years. And so I wonder if we're just horrible at figuring LTV out, especially in the early stages.
It's such a brilliant question. No one's asked me that way. And it's a way that I can build on Sam's too, where I think I can take a stab at a first principles answer to it, which comes right out of the book. Okay, so I got to do a little, there's only like 2 underlying frameworks on the book. And the first one is like the answer to when you're ready to scale. You have to get product market fit first, then you have to do go to market fit, then you have to do growth and moat. And I'm not going to hide behind some qualitative fluffy things. We're going to quantify the crap out of what those things mean. And so with product market fit, I think if you read the Wikipedia page, it ranges from some qualitative answers like, oh, you just know it when you have it, blah, 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 all the way down to some like really rigorous ones like Sean Ellis. If you survey your customers and 40% say they'd be very disappointed if your product didn't exist. Love it, just don't love surveys, right? And the human bias that can come out of it. So like qualitatively speaking, what product market fit means is that when we sign up a lot of customers, most of them see and realize the value that we promised them and that they intended to have with the purchase. That's what I think product market fit should mean. And I think in most of the businesses that we work on and run, in the long term, to your point, Assad, that is best represented and quantified by retention. Now, like, unless you're Salesforce with 500,000 customers, you don't have a very accurate view of your retention, which led me to frame an important concept in that for startups, which is to define your leading indicator of retention. And so what that means is when you sign up a customer, and AJ implemented this at QuotaPath, what are you going to see in the first month from either a behavior or action or outcome perspective that if that occurs, they will likely be with you forever. They will likely retain at the year. They will likely buy more. They will likely renew time and time again. And so the book clearly defines that. We've rolled this out with every single one of our portfolio companies at stage 2. I personally think it should be the first slide in every board deck at a seed funded business. I care less about how much you sold and care more about what percentage of your customers are hitting the LIR, as we call it, the lead indicator of attention. And I also go so far to frame it as down to 3 variables, which is P% of customers do E event every T time. So Slack had probably one of the most famously documented examples, which was 80% of customers send 2,000 team messages every month, right? Super honed in on collaboration and what they do, et cetera, right? So that would be my answer to you, Assad, is I agree with you. LTV is very hard to calculate. Conceptually, what we're trying to understand, and when I say you should correlate ICP to LTV, I'm qualitatively saying you should correlate ICP to the segments of customers where you create a lot of value uniquely, and they want to renew and expand. And I want to measure that through attention, and in the short term in startup world, define my LIR and hope that it correlates over time, and we can actually calculate that after a year. Now, the final take I'll make, Assad, is you look back on LinkedIn Recruiter and realize that was the only tool that you continue to use over 8 years. I would argue that's because those other tools lost product market fit. And everybody loses product market fit. I've never seen a business scale where product market fit does not become at risk because of movements in technology, macro conditions, competitive landscapes, customer desires.
Yeah.
And if you operationalize your business in this way, where you're measuring product market fit based on retention in the long term, but the lead indicator retention in the short term, you will know when you lost product market fit, arguably 3 quarters before your peers, so that you could become more like LinkedIn Recruiter and less like some of those tools that you end up replacing.
This is super fascinating in the sense that, Mark, you said we implemented this. Just to give context to that, we have a North Star metric. Our time to value in commissions is running payroll and payouts. In 2023, I think that number was 55%, meaning 55% of our customers were running payouts inside QuotaPath. That was a major issue. As you can imagine, if you had a payroll company and 55% of your customers were running payroll with you, that would be a big problem. So it was a big problem for us. What we realized and have moved and shifted, and this is in this conversation definition of ICP, is that our SMB market was just wildly too complex of a product. And operationally, they were not strong. They weren't robust enough to be able to pull in and handle. And their HubSpot CRM instance didn't have the right fields, didn't have the right objects, and they were too cheap to buy a solution partner to help.
Even
them.
though you had the most inbound demand there, and you had the
highest close rate,
we were
closing 45% of our deals in
live
SMB.
Example to
and
support the ICP. Right, exactly.
And looking back at it, we had to rip out, and we talked about this at the board, it's out with the old, in with the new. Our mid-market on the other side of the spectrum was performing extremely well, but our product wasn't mature enough. So we knew what our ICP was. We didn't have product market fit because the product didn't actually support the ICP that we needed to have. And we had this existential crisis of oh my God, what do we do? Well, we had to rip down burn, to Mark's point earlier, and we just had to foundationally build the product maturity to that ICP. Today, that number is 72% of our customers running payouts. It's 89% in the mid-market segment to that point. Nice. Our win rate is actually gone down to 27%, but with HubSpot and Rippling customers, it's 44%, which is just in the board meeting, this literally happened. Liz Christo at stage 2 was like, AJ, why don't we just go only after Rippling and HubSpot customers? Why are we even dealing with Salesforce? Which was a good conversation to have. But I would debate that, to Mark's point, your product market fit is always changing and your ICP is changing. And in today's world, it's more noisy than it's ever been. And you have to, as a founder or operator, have to look at your ICP almost feels like on a monthly basis. It used to be quarterly. Now it's like monthly.
Who do you think should own product market fit in the organization
CEO.
other than the CEO founder? Obviously, they should care, but like it feels like so much of product market fit quantitatively is something that go-to-market will see before everyone else, right? Like these are go-to-market
I'm
metrics.
curious what Mark's answer is on this. My answer is the best thought partner in the business should own it. And for us, I would say it's Ryan Milligan is been like very, very stringent. He's the one that's like carrying the flag. I could see our CPO Wyndham being that person.
But most CROs are afraid to talk about product market fit, right? Like we had Lemkin on
Well, that's a
Kyle's
problem.
podcast a little while ago, and he was saying if you are missing targets and you bring up product market fit, that's a fast path to getting fired as a CRO.
I
So
mean,
it seems like this
that
disconnect
isn't-
between they're the best.
Mark,
ones.
what's your response to that? Because that's
I really think it's the product owner in today's organizational design. Like that's their job, is to like define who are we building for who, which is for whom, what are we building for whom, which is another way of saying product market fit, right? So like, so I do think it's the product owner. And I think like that could be problematic for the CRO if it's wrong, or if there's not a big enough market that it's built for to grow into the growth aspirations. And you can actually calculate that. So I do think it's the product owner. And then I want to just build on the narrative that you guys have here to simply make a connection between our conversation here, which I think is highly applicable to SaaS orgs 2-3 years ago that are still SaaS orgs, and highly applicable to today's environment. But I want to attach it to what it could be from a first principles in an AI native land. And, if you're like, to AJ's prior point, like you should constantly be recalculating ICP. And I would say like the best orgs out there today and last year maybe did it once a quarter. Maybe their ops team sat down and did it once a quarter. And maybe they did it on like 4 or 5 segment attributes. Maybe they did it on SMB, mid-market, enterprise.
It was like validating what there was selection bias to it. Like
if I were running ops, if I were running RevOps and I was trying to do this in like a pre-AI world, I'd be like, okay, every quarter we're going to split up the funnel, pipeline, and customer base by SMB, mid-market, enterprise, by NAM, EMEA, APAC, by finance, healthcare, technology, and see how those metrics look, how they move in which direction, to see where we have both product market fit and go-to-market fit, and redefine my ICP. Because there are some factors that may have caused the ICP to shrink because of new competitive entrants or economic conditions. And there's some areas where ICP could have expanded because of product releases we've had or whatever. Okay, so that's today best class, rarely see it. Post AI, we can do it hourly on an infinite number of attributes.
Yeah.
Like just constantly looking like, okay, the team went out, whether that team's a bunch of agents or a bunch of people. And it's just like, I'm looking at all these different factors in terms of like stage 1 to stage 2 to stage 3, pipeline movements, to like, customer success movements, support tickets, to like all these different data. And I can do that on an infinite timeline, on an
This,
infinite
by the
number
way,
of
is like underappreciated how powerful this can be. I can tell you on, like, if we pull this thread and say, what about on the content side? So something we're building right now for Topline, which is interesting, is if you look at big movie studios or even CPG brands, when you come up with a new show or new product, you would give it to this controlled audience to try and get their feedback on it, right? That are representative of the overall market you're trying to target, right?
Yeah.
And so you would get all this interesting information. I like that character. That character didn't make me feel this way. I like the taste of this product. I don't. But if you're a small CPG company or small media company, you can't do that. It's too expensive. And so what you can now do is you can go into Gemini, let's say, or one of these models, and you can basically create these audiences for whom your content is supposed to be. So once we record this podcast, we can upload it to that and say, hey, what's this audience going to think about this? And specifically in the context of retention on YouTube, which is a really important metric, is what % of your audience that clicks this episode stays till the 1 hour mark. If that is high, your episode gets thrown out into the market. If it's not, it gets pulled. And so you can say, tell us what retention will look like. What are the adjustments we need to make? And the people that have come up with this, they have found that today Gemini can tell you up to 80% accuracy where retention will drop. which is insane. So now any small media company, top line included, can put all of its content through this and can get all of this really interesting information about what's going to work and what's not going to work, which was impossible before. It's really, really powerful.
It's crazy. That's a great example, great analogy to it.
So what do you think that, as we are entering this phase, we've gone through already quite a lot of transformation in how we sell things over the last 20 years, right? There was the on-prem to SaaS transition, which led to essentially the creation of this assembly line in sales team, in go-to-market teams. We broke everything down into small pieces. We were able to teach it to younger, more junior people, one piece at a time, because teaching them everything back in the day was too overwhelming. So it was hard to scale teams that way. So we were able to bring people in and scale them up. We were able to create a really efficient systemization of how a lead goes through our funnel and then becomes a customer, et cetera, et cetera. But, so there are good things that came out of that and bad things that came out of that same thing. Yes. What's your take on, as we exit SaaS and we enter this AI era, what are the strengths we're taking with us, and what are the biggest weaknesses that we need to try to address with this new technology that is now?
Yeah, the short answer, and I'll unpack it, is we're going to be able to build off the systematization, the scientific elements, and the data that came out of this last generation in order to probably reverse the specialization and collapse it to a single role and find a much higher level of efficiency. Okay. So, and I would say, like, I have a lot of conviction that right now, what is accessible to unlock massive efficiency improvements in every go-to-market org is, first milestone, drive selling time from 25% to 80%. And for those of you who aren't familiar, selling time is like, if you look at a rep's week, what percent of the time are they face-to-face or on a Zoom with a customer or prospect? Okay. And like,
revenue generating activities, baby.
Right. You're great. RGAs, right? So like drive that from 25 to 30% to 75 to 80%. That is possible today. It's not easy, but that's your first North Star. And then your second North Star is to collapse your go-to-market org from SDR plus AE plus AM plus CS to one role that owns the whole thing. Right. Those are my two convictions. All right. So to back up and give a little flavor there, Saad. Yeah. I mean, if you weren't around in the 80, 90s to the 2010s, like in the 90s, like I remember when I was starting the HubSpot sales team, the biggest agenda on go-to-market orgs was CRM adoption. Everyone was like, yeah, no one uses CRM. Like, it doesn't matter. You can't run a forecast. There's no data. It's all on pen and paper. And I was like running into HubSpot, worried about that. Was never an issue. Because we had one of the first inside sales orgs up until like 2000, 99% of deals were enterprise and 99% of deals were done in person and a handshake. And like, we just take for granted today. Is like, now we have a ton of deals that are done over Zoom. You never meet the person. And now our reps are dependent on the tech. And because of that, we went from...
In the last 12 months, our three largest customers, high six-figure, seven-figure spend, I've never met them in person.
I mean, COVID catapulted it. Like, up until COVID, like the line on when you needed a handshake in person was probably like 50 or 100K. Now it's limitless. You know what I mean? So like, yeah. So we have to appreciate those massive shifts from going from like, how do we get the data to what do we do with all this data, and the tech getting so good to meet us where we are. And RevOps wasn't even a thing in 1999. So now you have this whole team that's focused on like science and process and codification. And that's wonderful. And like, now I just think like, the first phase is, like I said, is like a lot of workflow streamlining and automation. And I find this to be a general observation across all of AI, is like, perhaps make an analogy to like, remember Web 1.0, the way we talk about that? When the internet first came out, we thought the internet was putting your brochure online. We thought that's what it was. And we couldn't conceptualize user generated content yet. We couldn't generate all the piping around like Twilio, all the sharing economy movements around Uber. It just was very difficult to envision that. And I kind of feel like that's where we are with AI right now. I feel like AI 1.0 is about current workflow streamlining. And that's why I think I'm not that bullish around the survivability of all the businesses that are getting funded today, because that's what they're focused on. And I think AI 2.0 will be about workflow reinvention.
What
And
does
it's
that
just really
look
hard
like?
to conceptualize those. What?
If you're thinking about the collapse of SDR to AE,
Yeah.
AM, CS, is that agents sort of like an orchestration role where you've got like an agent
Eventually, I think there's a blur around that. I would say the first way I'd frame it is, obviously probably Aaron Ross's predictable revenue in the beginning of this century was probably the catalyst behind the specialization movement that occurred in go-to-market. First with the carving out the SDR from the AE's responsibility, and eventually carving out, and ironically, I'm talking to Nick Mehta right after this conversation at Gainsight. So like he played a huge role in carving out the CSM from their responsibility. Now we went too far. Like in my opinion, in the last like 5 to 10 years, more companies specialize those roles than should have, just because it was in vogue and probably some VC did it successfully at one company and thought it should apply everywhere else. I have a particular framework as an example that I use to guide people as to in the current and past era, whether you should carve out the CS and AE role as an example. It's a two-folded workflow, which is number one, what % of the overall lifetime value potential of a sale is captured in the first deal. If it's 90%, then carve it out. Like, don't waste your AEs on that. If it's not, if it's more like 10%, then the second question is how complex is it to capture the other 90%? If it's highly complex because you have to get over to Europe and Asia or some other department, keep the AE involved. If it's not, if it's just like contact or CPU like enhancements, then you can carve it out. So like there's pros and cons to it. Like the advantage to specialization is you can hire for the role specifically, and you don't waste arguably the most important skill set, which is like big deal selling on meeting the setting and customer, relationship. But it comes with a cost of local maximum optimization, right? So like if you comp your BDRs on how many meetings you get, you get a bunch of shitty meetings.
Of course.
If you comp your reps on how many customers they close, you get a bunch of shitty customers. But
100%.
if you have the rep is in charge, they have to book their meetings that they have to service, that you get good meetings. And if the rep has to deal with the customer after the sale, they don't sell shitty customers, right? So there's a cost. And I just think like, AI fixes that, Sam.
We're doing that at Pavilion. At enrollment managers, we're comped only on signing people up.
Perfect.
And we are saying, now we had a consultant in who was at GA and some education companies saying they tried having the SMB rep own retention, own renewals, and it didn't work, and they needed to carve it out. But we are ready to say exactly to your point, Mark. We need people to stay. It really doesn't do us any good for somebody to sign up and stick around for 3 months, 6 months, or 12 months. Like we make money on people when they stick around for 3, 4, 5 years, and so we need the rep to have some point of view on, hey, at a minimum, it's not even, I'm going to make sure it's a good fit. It's also, I'm going to be responsible for making sure I'm going to check in with this person in 3 months and make sure that they're doing all the right things. So, we've just made that change exactly.
Yeah, and someone that never moved to it was like a McKinsey or BCG as an example, right? Like a partner McKinsey, they go out, they meet people at events, they sell them, they service them because they have to. That was the right mode. And to answer your question, Sam, is I just think AI eliminates so much of the busy work that it eliminates the positives of specialization.
I have a question on this. And so I think about this a lot around the % of time that a person spends on activities that actually make money versus admin, project management, all of this, right? And you're right, like it's 20-25%. We have this opportunity to move up. At the same time, there was this really interesting research put out by David Spitz and Jocko a little while ago around go-to-market efficiency. And it was this metric that they'd come up with that measured how much it costs us to generate a new dollar of ARR. And what they were showing was, looking at public companies, that it has just gone negative for quite some time. Since ZERP, this number has been getting worse and worse. It's costing us more money to generate new revenue than it used to on average. And so a lot of what they were saying is the go-to-market has to do something to fix this problem within itself. And the conversation we were having is that maybe it's just the fact that the world is more competitive, it's harder to win, it's noisier, it is more inefficient to go to market, and it'll be difficult to balance this out within go to market. And instead, what we might have to wrestle with is a go to market machine that is getting more inefficient on average across the market. But at the P&L level, we can manage that inefficiency because we've got all these ways to become more efficient. We can outsource, we can automate, we can do all of these things. But now you have AI in go-to-market that is doing something as intense as moving a rep from spending a quarter of their time selling to maybe half their time selling. Do you think that this shift alone, this moving up towards 50, 60, 70% of a rep's time spent selling and making money, does this solve that inefficiency problem? Or at the same time, the ecosystem is getting so much larger, so much faster than before because of AI, because it's making building things easier, that no, it's still going to get harder and harder to generate new revenue. All of these things won't fix it at the go-to-market level. Companies will have to fix it at the P&L level.
Mm-hmm. Yeah, it's a great question. I have a tremendous respect for Jocko and Dave. Dave has so much rigorous research, and Jocko is a genius methodology designer. I do stuff with both of them. But let me just go in honestly. The first off is, just from looking at from a just pure data standpoint, if you take a rep who is able to sell for 25% of the time because of admin work, and you just do almost like a control group on that, just fix it all. And I mean, saying just make it stable. Their skills stays the same, the demand stays the same, the product market fit stays the same. And all you do is eliminate the admin work such that they can be selling 75% of the time. Just spreadsheet wise, you're tripling their productivity. Okay. And that's, I think, the opportunity that we have there, regardless of efficiency or inefficiency. We're we can poke at that together. But that should play out. Now the other piece that's going through my head is, I think Jocko and Dave's work on that and their position on that is a little bit more in reaction to the positive results of product-led growth. And some of these phenomenal Silicon Valley based companies that had such strong product market fit that an inefficient order taking oriented sales team was crushing it. I remember when we started at HubSpot, Google was crushing, right? They were at that stage. And I remember that a lead at Google, if you were a sales rep, a qualified lead at Google was someone that was spending $10,000 a month with Google. That's not selling.
Yeah. That's
if you took that rep and told them to go to Databricks in the early days to cold call CIOs, and this happened all the time, is these VCs would be go find someone at Google, and they poached these directors out of Google, and everyone kept failing. Didn't work because they were order takers.
And also, by the way, Google didn't pay commissions to individuals; they paid it as teams. So it's not like these reps didn't even have incentives that they could control at the time. So
and the hiring profile was you had to have an Ivy League degree and no sales experience. Ivy League grad. I mean, it's and you saw this start to be replicated at other places like Slack, and then eventually, today, at OpenAI to some degree, and they're struggling a little bit in the enterprise because they never really fixed
100%.
it,
Yeah.
right? So I think that's a lot. When I talk to Jocko, I think that's where that comes from, is you just had such phenomenal product execution that you could get away with an inefficient sales org and people who didn't really know the basics of selling that looked really good, that were producing $5 million a year, such that VCs were like, oh, go copy those people. And then this whole generation of kind of spoiled reps because of such phenomenal product execution. But that runs out at some point.
Yeah. Mark, there's something you said earlier and we started to talk about and we're talking about it now, which is this idea of consolidation of roles. You mentioned CS, AM, SDR, AE going into one role.
Yeah.
And I'm curious if in the book or just top of your mind, like who comes to mind that has done that successfully today?
I think Assad
So
knows
many,
better than that
by the way,
because I'm talking to Kyle Norton
Norton?
at 5 today. I think
Yeah.
he's doing some good stuff. I'm talking to the Versailles woman next week. And then you turned me on to Elise AI, one of our
Yeah.
LPs as well,
Oh,
Assad.
yeah.
Who's like, so like
Matt.
I haven't found it yet. But
I
I
can tell
will
you a
say
little
that,
bit.
yeah, go ahead, Assad. Do you have some
So-
ideas? Yeah.
If you look at manufacturing SaaS, manufacturing SaaS has traditionally had a less of a fragmented go-to-market team.
Yeah.
Specifically on the post-sale side, they have always hesitated to use the classical SaaS model because if you think about manufacturing, it's a very land and expand sale, right? Like
Yep.
you start with one plant, but there's like 100 more plants out there that you can go and get. You're going to start really small, and most of the value is captured after the first deal. You're selling to, in many cases, plant managers who are not technology forward. And so you have to build this relationship. You have to build this trust with them. And handoffs are a way to reduce trust with a person like that. You've built all this trust. You got the first plant. Now you hand off this account to an AM or CSM. It would cause too much friction. So that part of SaaS, actually, the really good companies over there would either use the hybrid model where the AE would eventually become a book of business manager. And so they would have these hybrid roles, and it would start more hunting. It would transition to more farming over time. Or you would have the AE hold the account for 2 years, sometimes even 3 years. Whereas like in traditional SaaS, it's like a 6-month to a year type of handoff. So there's that where there's just less. If you look at the assembly line, there's less nodes in the circuit in manufacturing SaaS. That's one smallish example. If you
It's
look
a great
outside-
question, AJ and Assad. I think it's a great example. And I might attempt to extract it out to almost any strategic account team, right?
Yeah.
Like if we were to go into Workday or Salesforce or perhaps like Snowflake or Databricks, like when you're selling to like this $10 billion global account, like you didn't get that lead from an inbound lead. You know, like
you did the work.
you did account-based marketing and selling, and you were a part as the AE of getting in the door. You were a part of getting the first contract, and you were a big part of the 3-year expansion to make that a $20 million account. Now, the difference is, it's a great question, AJ, because it could give us a blueprint, is underneath that person. Like I remember one of our LPs ran the IBM account or something at AWS. That was his entire job. His team is 40 people.
Yeah.
You know what I mean?
Support.
Like, cause it's like a $500 million account, right? So like that might be a blueprint for us, is take that person, but get rid of all the people below them. And
Well,
that
because
might,
look, we're all like, as an operator CEO, I heard that. I'm sitting here as a CEO, like, yeah, I want to do that. Can I just do that today, tomorrow?
We've got somebody on the call that does it. That's how Austin runs STA, by the way.
That's
Is
very
that
true.
He's got a team underneath him, but he's doing the lead gen. He's doing the first call. If you're running a search with him, I see him on a lot of the calls. Not every call.
But that's a services business, and that scalability, Sam, as you found out yourself, you're like, you've said this yourself, I can't be everything to everyone at Pavilion.
But it's more scalable than you think, AJ. Like we're about to do 15 million. We did 2 million in January. We'll do 15 million this year, probably. Like it's scalable beyond what people think it is, right? Like I take every call from any partner that comes into STA partnerships.
Well, you're a maniac in the best way possible.
I think the other place where you see it is if you have consumption-based pricing. So if you look at Snowflake would have the AE have to own that relationship for much longer than traditional seat-based SaaS. And so there are examples of this working really well. The BCG, McKinsey examples. I think it just comes down to you have to decide if it will work in your business or not and make the call and do it.
Like, do you experiment with it? Do you do like a team?
I think so. Like, I think that's a great
experiment.
question, AJ, of like, how do you bring this stuff out? Is I go to the late Clay Christensen's, like, disrupt yourself, right? So you don't go in, don't be like, okay, we're doing this, and take your, like, pick a number, 5 reps, 10 reps, 20 reps, whatever your team is, and be like, change to this. You run the proven motion, and then you create a competitive team, which could be just like a GTM engineer with an AE, and just be like, can you try to outperform the team?
Yeah.
And you could do that with like I did actually a lot of this with BCG after HubSpot before stage 2. One of the things I did was a senior advisor, and I was trying to like take these $10 billion companies that were still in the on-prem world and pull them into SaaS. And that's what worked, was leave your thing going, but let's find a sandbox where we can stand up an inside sales team with MQLs. And it was either like, oh yeah, the Florida territory seems open, or here's a new product that we could play with. Like, that was trickier in a $10 billion org. But I think that's going to be the key, is to have these competitive teams to experiment and try to outperform the core business.
I mean, the timing of it is correct. You have these traditional SaaS companies that are reinventing themselves, pulling out AI native products, have an opportunity to create quote unquote teams to do it. But the way it's doing is kind of, you think about this traditional overlay AE that we've had in years past. This is an opportunity where someone can come in much more as a consultant, strategic, act as an SDR, act as an AE, act as a CS and AM to like really help push the envelope in whatever you're launching to become a platform. So many companies are have to move from point solutions to multi-platform. Like, just like you said, on-prem to cloud was like a moment in time where you kind of had to experiment. This is another moment in time where teams
and the
get to
bar
be
feels
experiment.
so low and achievable.
So
Because when you
low.
think about like, okay,
Yeah.
let's take like, we have this SDR which costs us 50 or 60,000, and let's factor in some like management of them. And then there's this account executive that costs us whatever, 200,000. Then there's this CSM that costs us X. And then maybe an account manager in there, and we have management layers. And like, what is that pod producing? And at what cost? And if we could go find a ninja account executive, when we have to talk about what that profile is, that can cost us 300,000, but deliver even 20% less than that pod.
Yeah.
That's a much better business.
I mean, you have a control group. You literally have a control group right there to be able to like measure and experiment against.
This speaks to the whole concept of founder brand. I mean, me, Asid, you, Mark, AJ, like that, especially me and Asid, this is basically what we do. Like, I drive, 90% of the revenue for Pavilion, and that's both a blessing and a curse, but it's certainly true that if you think about it in terms of how do I maximize the productivity of my superstars, and how do I take one A player and just make that person incredibly productive, as opposed to almost penalizing the business for it and saying, well, we got to take those good leads away from that guy there, or gal.
Your territory gets smaller every year.
And we got to make more fair. It's like, okay, so you're going to just take everything down to the mean. It's a really interesting idea.
That's a tough debate, Sam. It's a great point, because I can look at Assad right now and be like, given what we've achieved so far in AI, I can make a strong argument that in a year or two, Assad is able to double revenue by himself with no employees. Like, it's just like, we're getting there. We are getting there.
Maximilian are not listening.
Right. Same with you, Sam. Right. So we're getting there. And that's very interesting. And it's very interesting with your founder mindset. But I guess I play devil's advocate to it. Well, God forbid we find another Assad, you go even faster.
Mm-hmm.
You know what I mean? It's just systematizing. Right.
What is the enterprise value? And that's the constant debate that I think especially me and Asid have, which is, should we lean in? Should we distribute our expertise down into the organization and build teams? Or should we just own the fact that we are the rainmakers and design an organization correspondingly? This has been a great conversation.
That, just as a closing thought, I think the idea of looking for rainmakers, like not building for the average B player, like a lot of these go-to-market models in the SaaS era were built with this assumption, like we need to make this work with B players because that's what we can find. That's what's easy to staff. The volume of hires we're going to have to make, it's going to be a lot of B players. Can this work at the B level? And I think having the audacity to say, I'm going to go and look for these rainmakers, and it's going to be hard to find. But when I find one, I'm going to try to figure out as much as I can how to make that person more productive, like how to get the most out of that particular person and think differently and creatively about that. I think that's a really interesting opportunity that in the SaaS era, we never really cared about. Instead, every year your territory got smaller, your job kind of got harder. The money you made became harder to make every year. Those real A+ level individuals, they always just like got disheartened over time in any organization and moved on. And very few organizations thought about how do I deal. It almost was considered a negative. Like if the person wanted something special, we don't want divas in our team. We should fire the divas. I think there's an
I'd
opportunity.
heard would always say that, AJ, fire the brilliant jerk.
Who said that?
The bizarre voice guy, the guy that didn't invest in Trendkite.
No, Brett Hurt. He did not.
Yeah.
He did not invest. I have a phenomenal story about pitching him and his wife at 9:30 p.m. on a random Tuesday, and Brett did not end up investing. But that's a different story.
He missed out. Mark, first of all, thanks for being our
Mark,
guest.
it's always great. You always make us feel so good about ourselves. We just need to have you on more to just say,
thank you.
AJ, what a great question.
I love these.
What a fantastic question.
Okay, so first of all, before we do any wrap up, and Asid, maybe you're going to ask us all a question. But Mark, the book is available on Amazon. Just go to Amazon.
Everywhere, Amazon. I mean, that's where I'd go.
Everybody but Mark has the book right now.
I know everyone has it. Please send me a copy. I'll sign it for you. But yeah, that's the best place to go is Amazon. The one thing I didn't get to plug, which is very important to me, is I do donate the proceeds for my books. This one is going to mental health, 100%. So I think that's just like another big driver for my motivation and getting it out there. I know all of us, but all four of us have had deep personal conversations about our respective mental health on park benches in New York and various places that we've gone through. It's just been a thing for me too. I struggle from very severe anxiety through my career to the point that it was debilitating, like what about Bob type debilitating. And it's just like, I'm very blessed to have been, given certain resume accomplishments that people look up to me for things. So I can be very vocal about my struggles, and not everyone can. I think when we're looking at a candidate and find out 5 years ago they recovered from cancer, I think we elevate that candidate. And if we find out that they recovered from like a terrible mental illness or anxiety, depression, whatever, I think we draw concerns as a society, and that's just not right because it's a disease. And so, the internet had some amazing progressions for society and also had some negative impacts, some of which were in the mental health arena. There's projections that similar thing will happen with the AI world. And this is just my way of contributing to that.
I love that.
That's awesome. Well, hopefully everybody gets it. The science of scaling. And the subheader is using data to decide when and how fast to scale revenue. Mark.
I've read it, by the way. It's really good. It's really, really good.
Thanks, man. Hey, I always love to say, like, what's the one thing that you just like took away? Because that just helps me to be like, what hit for you? What was the one thing that,
I think a lot of books in sales and business in generally feel like you're reading a microwave manual. Like it doesn't evoke emotion, right?
Yeah.
It's very bland. There's good content, but it's bland. It's like I'm reading a manual to something. And this one, like, you feel it while you're reading it. And the first book was like one of my favorites. Like, it was genuinely shaped me a lot. And so obviously the bar was high.
Austin was 5 years old when it came out though, Mark. So.
I know, seriously. No, well, thank you for that aside. That was something I experimented with on this one. And it was easier with AI to do this. Was we all can tell a story about, like, I'm trying to make a point around the VC. You set your annual plan and you're like a Series A company, you're like $4 million and you set your annual plan. And after the first quarter, you miss by like 30%. And the VC comes and like, increase hiring, catch up.
Nah.
Why? It's like this makes no like where it's broken.
When the going gets
we're
tough,
just gonna dig a deeper hole. Yeah. And so like we all have those stories. And in the book, I didn't try to just jump into like, here's the framework and I tried to have the 2-page cool story.
Yeah,
that AI helped me like crystallize a little bit. So thank you, Asad, for
John McMahon had that in his book as well. Totally. Like he told these stories, and it was like the first sales book that had like all these stories in it, and it like connected so much deeper. And so I really liked it about.
Thank you.
Here's the thing: I got two things really quickly. One, for anyone that's gotten this far, because it's one of our longer episodes. If you're listening, the first 20 people that mention this, Slack us, any of us in our Pavilion top line, will buy a copy of Mark's book for.
Thank you.
Yeah,
that's awesome.
I mean, I'm standing alone on an island for it. Sam and Austin didn't speak up. That's okay.
Thank you.
The second thing I want to we usually ends with shout outs or wows, but I'm just going to jump this and just say thank you to Mark. As a lot of my listeners know, and Sam and Austin also obviously know, my dad passed away at the end of the year. When my dad got sick about a year and a half ago, Mark was one of the first people to text me. and just really thoughtful. He's followed up and as soon as he heard the news of my dad passing, sent me a really thoughtful text. So thank you, Mark, for that. And the mental health piece of that, I think that it just adds to it when you have loved ones that you're close to pass away and you're still made to show up every day. And as CEOs, we still have to feel like we show up. It's just really great to hear. And so thank you for that.
Thank you, AJ. Appreciate recognizing that. Thank you for opening that window. A lot of people don't know this, but I am a deacon in my local church. I also am a follower of every religion. I've read all the the scriptures, from Muslim to Buddhism to Judaism to Hinduism, one of my favorites. And I have a prayer journal that I keep daily because I usually say gratitudes publicly because when you bring religion in our conversations, people get uncomfortable, but we'll call it my gratitude journal. And AJ, you were on it and are on it, that I just kind of think of every day just to, I believe a little bit in the spiritual manifestation stuff, but it really does help me give me perspective on the things that are bugging me that probably shouldn't.
I love this.
Thank you.
This is a
Thank you
good
so
place
much,
to
Mark.
end it, Sam.
Makes
We
a
don't need to
difference.
do questions. This is beautiful.
I think that's the right way to end. Mark, thanks so much for being our guest. We love having you on the show, and we love having you part of the Top Line family, and congrats on the new book. Thanks, everybody, for listening.
Always appreciate it, guys. Thank you.